Hello, welcome to Finance in 5. I'm Melissa Stein, certified financial professional and owner of Stein Wealth Advisors, and this is Josh Stein, certified financial planner and owner of Stein Wealth Advisors.
Hello.
Thank you for taking the time to join us today. We're excited to talk to you about the markets and some of our take on what's going to be happening in the future here, looking at the overall macro environment, as well as some of the major indicators that are impacting you and our clients' portfolios today. We want to talk a little bit about the Fed, implications of that, the election, if we think there's a recession on the horizon, and also important things like inflation. We'll also talk a little bit about what we think the implications are on your portfolios and some of the thematic changes that we've been making to help get you in the best position. Josh, I wanted to ask you a question about your overall opinion on the macro environment and sort of like in general, like what's the feel right now in the market?
Well, in general, I think the feel in the market is worry and concern about some of the major political and economic events that are happening as we speak. Obviously, we have an election right on the cusp, and there's a lot of important factors that will go into what happens economically from that. We can talk a little bit about that, as well as the Federal Reserve making a significant amount of policy that will have impact on the financial markets and the overall economy. That being said, all those things together, corporate earnings are still just as important as ever before, and ultimately that's going to drive the either upward or downward trajectory of the stock market in particular. And thus far, year to date at least, we've had a pretty good run. Do we think that continues? Hard to say. One nice fact that I know is every single time that we've had an election year, the stock market has averaged positive performance 1 year following. So I know for a lot of people, that's a big concern is what happens post-election. And although we really have no idea historically, it really hasn't been a fearful event.
And most of the major indices have been up this year as well, and our portfolios have been enjoying a lot of growth.
They have. I think the big surprise is potentially the bond market. The big expectation that when the Fed drops interest rates that yields would drop as well, and they really haven't. A lot of reasons why, but for all intents and purposes, the yields have remained pretty strong, and that's had somewhat of a negative impact on the bond market overall. But we would presume that the Fed still continues to lower rates, and potentially we could maybe see some yields dropping here in the future.
And that means that maybe there's some pent-up potential and the growth for bonds on the appreciation side?
Could be, depending on where the Fed goes and how they react. I think, unfortunately, the bond market priced in a lot more rate cuts than the Fed has done so far.
Yeah.
And with some of the economic data that's come out that shows, maybe inflation isn't exactly where they expected it to be, and maybe the Fed doesn't drop quite as quickly, the bond markets react a little bit with higher yields. So that's still a big question mark. But that being said, I think there's no question that the Fed is still going to continue to lower rates. It's more a function of how fast.
Okay. I know also, we've enjoyed double-digit stock returns in the last couple of years. Do you think those returns will continue to be as strong as they have been?
Not in the next 12 months, no. I think overall, we probably still see good positive earnings overall, but I wouldn't expect double-digit stock market returns.
Yeah, and we've talked a little bit about maybe like single-digit strong returns, not necessarily negative returns, but maybe not as strong as they have been in the past.
Well, yes. And as far as a recession goes, the longer time goes by, I think the more probability is on our favor for a soft landing. We're not in a recession. We haven't been thus far. And depending on the next movements with the Fed, where rates go, where earnings go, jobs, things that really come into play, there's a very good likelihood that we will hit that soft landing, which doesn't necessarily mean we won't see volatility, but I would expect at that point stock market returns to maybe be less than they've been in the last 12 months, but not necessarily recessionary type volatility.
Yeah, and I know even with, it seems like the Fed has kind of hit that balance between increasing rates to get inflation down, which has definitely happened, but also balancing that with not increasing them so quickly that we go into a recession. But that also doesn't mean the risk of recession's over, right? Because, the reality is it may take another 12 to 18 months for us to see the impact of them keeping rates this high this long. So I know we've talked about being sort of, defensive in nature, but also wanting to continue to participate in both the stock and the bond market. But near-term outlook, I think we both feel pretty positive on that. I was hoping we could talk a little bit about the changes that we've made in our portfolio, thematically high level, to help sort of adjust to this environment to maximize return and minimize risk for clients.
Sure, absolutely. It's funny because you had specifically mentioned a lot of those factors that come very much into play as to where we are right now. Somewhat uncertain about where the next steps are, but still want to participate in growth. And the word quality comes to mind, and that's really become a big key component of a lot of the changes we've made over the last year, really driving quality both on our stock and bond side. So what that means is making sure that we own the right companies, the ones that are able to fare interest rate sensitivity better, have a lot more liquidity, better cash flow, good earnings over time, as well as on the bond side, we want to own good high quality bonds. So we're kind of looking to stay invested, but making sure that we are maybe ticking up a notch our quality factors. And that makes a big difference, in particular with a lot of the uncertainties with where the Fed goes, election results, all of those types of things. We're pretty neutral on our stock and bond mix. In the past, we've had some wide ranges of changes. There have been times we were very underweight bonds. There's been times we've been very underweight certain parts of the equity markets. Kind of back to like almost normal. And I know that sounds funny because there's not a lot of normalcy right now overall, but it really kind of feels a bit more normal to me right now.
I feel like this is the first time we're getting back to normal in a long time. I mean, quite frankly, between sort of the Fed keeping interest rates low from basically a decade from 2008 and 9 leading up to the pandemic, and then all the sort of stimulus from the pandemic and the shutdown and us recovering from that, I feel like for the first time in a long time, inflation back to lower levels. I know we're in an election year. People are really nervous about that. Although I know we also feel that the Fed is probably more impactful on people's portfolio and their decision making than the actual election itself. But I feel like we're finally getting back to a point where maybe stocks and bonds will start behaving well, like they normally do, or just behaving in general, because I think there's been a lot of manipulation there. And that's been good for us and for portfolios to be able to continue to build more stable portfolios with, predictable income streams for clients. So, I agree with you. I think general outlook's positive, even with this election year coming up. I mean, that kind of remains to be seen what will happen.
Right.
And we're going to talk a little bit more about that later in another piece. So we could absolutely expound upon what we think the implications of that are. But I mean, in general, I think, general positive outlook, it's a positive year in the markets. Most portfolios are up. And I think we have positioned well for what the near future holds. So I don't know, is there anything else that you want to talk about today?
Well, there's still some places that we don't love necessarily. Smaller companies with more debt. We've kind of stayed away from small caps, even kind of creeping up to the mid caps. High yield bonds, what they call junk bonds. We've really kind of stayed somewhat away from those. And a lot of international, in particular China, and emerging type international positions. We've kind of upticked our domestic growth. We even have a small uptick towards technology, really just trying to take advantage of the booming growth that we've seen in those areas, but owning the quality ones. And that's really what it's about right now.
Yeah, I agree with you. I think too, and I'll just kind of throw this out there. I know we didn't talk about this earlier, but there's a lot of hype right now around AI and stocks like NVIDIA and kind of what the implications are for that. I know I've gotten a lot of questions from clients. I mean, what are your thoughts on that?
Well, my thoughts are you definitely don't want to not have exposure in some of the growth areas. It's just a big driving force of our domestic opportunities here in the US, as well as really globally now. There's still a lot of questions around AI and how to invest in that. And I think that's certainly something we should probably spend more time talking about in a separate video. We could have a lot of long conversations about that. And I think even the election will have some impact on where those things go. When you talk about things like energy and regulations, and those are going to be big election type topics. And some of that could have either a positive or negative impact that trickles down to things like AI and other technology companies. Absolutely.
Well, I mean, in general, I think that, we do have a positive outlook regardless of what those election results are. And I think we are definitely keeping our eye on the Fed and some of this decision making around interest rates. That's going to have a big impact on clients' portfolios. And I think in general, following a sound investment process that's data driven, that's systematic and really lets, us look at the things that are really driving the market in your portfolios, which is really company profitability, right, and strong fundamentals. And, we'll continue to focus on that to do the very best for our clients. So we really hope you enjoyed, our discussion today. We like to keep it brief so that you can get an idea of what actually is or what we think is driving the markets. Thank you for taking the time to tune in and listen, and we hope you'll join us again for another Finance in 5 next month.